Hi everyone, this is Gage from the Stock Circle, and today we're going to cover my method. We're going to first start out with our initial scouting to find stocks that we can trade options on. We will be primarily focusing on going long about a month out, swing trading, and sometimes spreads. I will use FinViz or Thinkorswim for my scanner, my screener, and for this presentation I'll use FinViz. We'll start out with the on the descriptive channel. We're going to make sure the market cap is over $2 billion. We want to make sure we have adequate volume and it's a trusted company. The average volume needs to be over 2 million. That way the options are easy to get in and out of. IPO, I want to be more than a year ago to ensure that we actually have enough data to draw technical analysis. After that, we want to make sure that it is optionable and the price is over $5. Then we'll go to the fundamental tab. We want the PE to be above 0. We want them to be a profitable company. And we need to have the price of the stock below the 20-day simple moving average. And we are going to need the 52-week high and low. We need the stock price now to be at least 5% below that. I don't want to place stocks at their all-time high. For our channels, we want this to be in a channel up. No reason to fight against that natural flow of the market. And so we have these stocks that we can use along with some other results and some other personal recommendations to create a watch list. We will start out looking at HDB, then we will look at KO, and then we will look at BAC. My chart layout will be using the 20-day moving average, Bollinger Bands, and MACD. I occasionally use RSI, and I will use volume whenever I'm looking for an entry and exit. Our first example will be with HDB. And here you can see we've got our MACD, we have some volume, we have Bollinger Bands 20-day moving average. And now if we look here, we find that it's an upward channel. This meets our criteria, and we look for entries and exits. So we're going to want to enter about on the bottom of the channel where it's at a strong upward support, making higher highs and higher lows. We want the stock price to be under this blue line, which is the 20-day moving average. And we want MACD to be crossing over. This is all on the 4-hour candlestick. And we will be using this, and as you can see right here, MACD crosses over. It's below our 20-day moving average. It also needs to be at the bottom of our Bollinger Bands, which it is right here. And we will buy in here, going long. Following our criteria, we want to go about 1 month out, possibly around 5 weeks. And you're going to want it to be slightly out of the money. We'll get to that later. So we buy in right here, and we sell. There's 2 times that we can sell. Either our technical analysis is voided because of some sort of news, or it breaks through a support or something. If this continued to go downward here, I would sell at about a 20 or 30% loss. Versus whenever it goes up, I want to sell at our price target. I don't want to use set take profits. I want it to vary depending on the stock instead of a one-size-fit-all. That way, depending on the play, I can let my winners run more. So I would have bought here and I would have sold here once we get to the top of the channel. I don't want to hold to the very top of the channel because obviously the top isn't perfect, so it'd probably be more around here. But you want to sell once it's above the 20-day moving average. MACD crosses down. So we would have rode this wave, and we would have looked again. Oh, we didn't have one for a while. That's all right. There's tons of stocks. Right here would have been another place to buy in. MACD crossing over at the bottom of the channel, under the 20-day moving average, at the bottom of our Bollinger Bands. We would go long about a month out, and you can see that was at 45, 46-ish, and the stock is now at 50, and that was within a couple weeks. For another example, we will go with Bank of America, which is another stock in a upward channel, meets all of our criteria. If we look here, I've drawn arrows in our channel of where I have bought and where I have sold. So right here I would have bought. It's at the support. MACD, actually I probably would have bought right here. MACD is crossing over. We have confirmation candles. We're at the bottom of the Bollinger Band under the 20-day moving average. Everything lines up. We would have went long here about a month out. This one we arrived quite a bit earlier because it's not as large of a move. And we make that $1, $1.50 of profit on the underlying stock. And then we wait. We don't enter here. We don't mind. Right here, it's at the bottom of our channel at the Bollinger Band under the 20-day moving average. Would have entered about right here where the MACD is crossing over, and I would have sold around here. Now that it's over and I realize it's not doing a whole lot, I wouldn't have bought back in for any of this, but then you can buy in for breakouts. So I will play upward breakouts. I don't play downward breakouts because I don't play puts. I only go with calls. I would buy in here once I realize it breaks out and we see the MACD diverging. As we do that, we will try to sell wherever we can. I believe I sold right at 27 after this red candle because you can't time the top, but it's at the top of our Bollinger Band above the 20-day moving average. MACD was starting to diverge. That's whenever you want to sell. And then I would not have entered again until around right here. You can see the MACD is crossing over. We're towards the bottom of the channel, at the bottom of the Bollinger Band, below the 20-day moving average. We would have went long. Now notice all of these are in upward channels, but it does not have to be. I just prefer for it to be. If you look at a stock like Coca-Cola, you can realize it has a very steady pattern and it has a lot of opportunities for entries and exits. So right here we're saying at the bottom of the channel versus the top of the channel. At the bottom of the channel I would have entered right here with the MACD crossing over. See, this is a bit longer term of a play, but I would have held until it made it to the top of our channel. I would have had our price target just shy of 50, and then I wouldn't have looked at it until I realized that it's back at the bottom of the channel again. MACD is crossing over. I would have went long and sold again at this. So it's a little bit harder whenever it's a horizontal channel, but you can do it. And then for contract choosing, what contracts do we want? For our contracts, we want our expiration date to be mid-length out. We're not wanting weeklies or 2 weeks out, but we're also not wanting the calls for 6 months. So we're going to go around a month and a half. It depends on the stock and it depends on the play. You can estimate how long it should take if you do some analysis on how long it takes in between its highs and lows. For our strike price, we want it slightly out of the money. We don't want something extremely far. So if we were to trade a stock at 80, we would probably place it around 85, 83, depending on our budget. We'll get to that in a second. So we don't want it in the money, but we want it close enough to in the money where the theta is not bad, the volume is high, but we still have room to grow. Our volume and OI should be as high as possible. We do not want low volume or low OI because if we are going to do spreads, those need to be very easy to get in and out of. For IV, I want low to mid-range, 30 to 50%. I will make exceptions for lower, but I don't think I've traded anything higher than 60%. It's just too difficult over a month's time period to try to compete with that IV, with the IV crush. And then theta must be small. I don't want to take a lot of money away overnight just by holding, and if we're going to be holding over a month, it does add up. Also, whenever I'm choosing contracts, I only choose it on stocks that do not have earnings over the next month. And if they do have earnings, I want to sell before those earnings. So I can either do a stock that recently had earnings and doesn't have any for a while, or I can play a stock to ride up to the earnings hype as IV builds before it, but I will sell out before it gets there. For spreads, whenever I do spreads, they must have very high OI, very high volume. You're typically going to want to trade stocks like close to in the money AMD, SPY, XLF. You're not going to want to play small cap with spreads. You buy the one contract price and sell the one right above it. This lets you limit your risk. An important part of my strategy is risk management. I generally try to keep one contract less than $100. 90% of the time, I would say it's less than $200. I have a strict cut losses, or I guess a strict range, 20 to 30%, depending on the stock and how it's playing out, though I will make exceptions for riskier plays, or if something still has potential and it hasn't broken its support, just maybe IV has crushed or something like that. I will only take prices like we discussed earlier whenever it hits my price target, but never be afraid to take profits. And how to gain access to my calls. Visit thestockcircle.com and join our Discord. Link is in the description.